RealView HoloSolutions. In major cities all across Australia, weekends for many is an arduous trek between suburbs for a 5-minute glimpse of their slice of the Australian dream. Often, properties are only shown from their best side in the marketing photos, leading to many wasted trips across town and time waiting in queues for properties that aren't suitable. RealView HoloSolutions offers real estate hunters the ability to tour properties without first having to get there physically, allowing them to decide ahead of time if the property is really worth visiting. Our anchor market to gain a level of maturity for our product is delivered through a partnership with a major large property developer. This provides a steady stream of income in the first year of the project while we build a presence in the Australian housing construction market. In year 2, we'll be entering our largest target market, the residential property sector, where we partner with the real estate agencies to deliver our product to your average home buyer. The multi-unit apartment and townhouse market represents our first foreign venture as we target the culturally similar New Zealand population. Our final market sees a diversification away from the traditional property markets as we enter the destination market, working with hotels and resorts in Australia. The cash flow for the project, while negative at the outset, trends positive during the early years of the business, leading to a healthy cash flow at the end of year 5. This trend results in a positive cash flow from year 6 onwards, with a terminal value of 7.7 million. While the discounted cash flow reaches a high negative value in year 2, it then begins a steady return, trending to the black in year 6.
We approached estimating revenue using a bottom-up approach, as this is a relatively new and immature market. We have taken a conservative approach to growth, using an ever-decreasing sales funnel to predict potential customer numbers and sales volumes. For large property development market, we will contact quarter of all businesses plus an increase from the previous quarter by email. We assumed 17% of them would open email, 4% of them would click through, 11% of them would invite us to present, and 11% of them would sign up. We applied a 50% higher conversion rate to the New Zealand market, assuming less competition. For house construction market, we applied a 50% reduction factor to the number of businesses we are going to contact, as there are about 43,000 developers. We took a similar conversion funnel approach in this market, targeting large housing developers who are building multiple homes with similar configurations. We will contact quarter of all businesses in residential real estate market, plus any increase from the previous quarter by telephone. We assumed 11% of them would invite us to present, and 11% of them would sign up. In hotels and resorts market, we applied a personalized marketing campaign, reaching out to potential customers by telephone. We took a similar conversion funnel approach in this market too. Conversion rates and the initial market size will have a significant impact on the sales volume. We assumed that the housing market would continue with the predicted level of growth. We estimated the price point that the market would support based on standard photography package rates and applied a premium markup. To test the price point and assist our entry into the market, we applied a staggered 10 to 25% discount to the residential property market during the first year. Being a technology service company, most of our expenses are fixed. Fixed costs consist of salaries, office and equipment expenses, and expenses related to cameras, mobile phones, and website hosting. Variable costs consist of the cost of the virtual reality solution, travel expenses, and legal expenses associated with contracts. As the business grows, the increase in labor costs is mainly due to the increase in the number of business development managers, software developers, and photographers. As we venture into residential real estate market, photographers are required to travel to each residential property. This will result in an increase in miscellaneous expenses. Our salaries and technology expenses are based on currently available data. Number of software developers, business development managers, and photographers are based on the sales volume. We assume that it would take about 1 hour for a software developer to create 100 square meters. We also assume that it would take about half an hour for a business development manager to answer a phone call and 10 hours to present to a customer. We assumed a photographer would take about 15 minutes to photograph 100 square meters. We also assume that it would cost about $200 per travel on average. Revenue and the expenses related to New Zealand operations were converted into Australian dollars using a fixed exchange rate.
RealView HoloSolutions are utilizing pre-existing hardware technology and equipment and customizing the experience to create our value add. This approach has allowed us to minimize the upfront investment costs. The only investment required is for the fit-out of a small office space and the customization of the software. All office equipment and software customizations have been depreciated utilizing a straight line down to a book value of 0 over their useful lives. Taxes are being calculated at the rate of 30% after expenses, with our tax year being January to December. In the years when our business is making a loss, the losses have been accumulated and used to offset against future profits for taxation purposes. The revenues and expenses have been modelled excluding GST, as this is collected and passed through to the ATO and should have no impact on our business. When we set up our New Zealand office in Year 3, we assume any foreign profits are returned to Australia. Our proposal to launch into 5 markets over 5 years is projected to return a positive NPV, creating over $1.1 million of value for our shareholders. This assumes a required rate of return of 30% and a perpetuity growth rate of 3% beyond the 5th year. Our projections demonstrate an IRR of 45.5%, showing a premium above the required rate of return of 30%. Based on our revenue and expense projections, the business will become cash flow positive from the 3rd year by $59,000, following on to make more substantial profits in the subsequent years, with over $900,000 in Year 4 and $1.56 million in Year 5. Looking at accumulative cash flows, the payback period is 4.47 years, the discounted payback period is 6.38 years. To achieve these projections, the business will need to be able to sustain negative cash flows during the first 2 years, where accumulated after-tax losses are projected to reach up to $1.7 million.
We performed sensitivity analysis as we cannot be 100% certain of our forecasts. We examined the New Zealand exchange rate, perpetuity growth rate, required rate of return, price, and sales volumes. When looking at our sensitivity to the New Zealand exchange rate, we concluded our sensitivity was low. This is because of the high correlation between the Australian and New Zealand currency, with a correlation of 0.92. And even if the exchange rate fluctuated by 2 standard deviations, the impact on our NPV would be less than $10,000. We also tested what would happen if the perpetuity growth rate was different to the 3% we had forecasted. We found that the sensitivity was low. Even if the growth rate was 0%, our NPV would only reduce by about $200,000, maintaining our positive NPV. Our forecast also assumed a rate of return of 30% due to the inherent risks of startup businesses. We found there to be a medium sensitivity that our positive NPV could be eroded if our risk profile changed and shareholders demanded a higher rate of return. With our IRR being 45.5%, any rate of return above this would result in a negative NPV. Our pricing model is based on a price of $500 per 100 square metres. This price is consistent across all our markets. However, we are proposing a discounted price for our first year in the retail residential real estate market to increase early adoption in this key market. We found there to be a medium price sensitivity with a minimum price of $370 required to keep the NPV positive, as long as sales volumes are also achieved. Finally, we looked at the impact of varying our sales volumes on our NPV. We found that if the overall sales volumes dropped below 68% of our forecasts, we would not be achieving shareholders' expectations of 30% rate of return, hence our NPV would be negative. This analysis also highlighted risks around our high fixed costs and our high dependency on the success of the retail residential real estate market, as shown in yellow. As such, sales volumes were deemed to be a high sensitivity. To assess the risks we have identified, we considered their likelihood and impact to provide us with an overall risk rating for each risk. Pricing is seen as a medium risk rating. We see it as likely that our pricing will be wrong and need adjusting as we better understand each market. There is a medium risk that our operational leverage will become a problem, especially if our sales forecasts are not achieved and we need to scale back our expenses quickly. When assessing competition, we see it as very likely that new entrants will enter the market, which could have a significant impact on our sales funnel. Large property developers may also develop their own virtual reality offerings internally. This high risk will need to be monitored closely to ensure our product maintains a technological edge and is priced appropriately. Finally, our analysis has highlighted the importance of achieving our sales targets, in particular for the retail residential real estate market. We believe our forecasts are conservative, so it is unlikely we won't achieve these targets. However, the impact of this would be severe, so the overall risk rating is medium-high.
Overall, our recommendation is to proceed with the business but do so cautiously. The strengths of the business are it is NPV positive, IRR is greater than the required rate of return, and we can accommodate a 32% drop in sales volumes while remaining NPV positive. The business's weaknesses are payback is not achieved until 4.5 years, and discounted payback is not achieved until 6.4 years. There is also a high dependency on the retail residential market. However, we can mitigate this risk by reconfirming our assumptions before we launch into that market and by terminating the business if cash flows from the retail residential segment are worse than predicted. Our high levels of operating leverage are also a potential weakness. However, we can reduce this risk by reducing support staff and ensuring our employment arrangements remain flexible. Uncertainty about whether our pricing strategy is viable is also a potential weakness. However, we can mitigate this by conducting market testing on our pricing strategy before commencing operations to validate that it would be market competitive.